Did you know that 90% of professional money managers, people with PhDs, expensive suits, and supercomputers, actually fail to beat the market over the long term? It sounds crazy, right? These experts spend 80 hours a week analyzing balance sheets and economic cycles, yet they consistently underperform a simple, boring basket of stocks that anyone can buy. While they are stressing out over complex charts and conflicting economic forecasts, a simple index called the SP 500 has been quietly turning regular people into millionaires for decades. Today, I'm going to show you the exact step-by-step math of how you can turn a simple $100 bill into a $1 million portfolio. We aren't talking about crypto scams, penny stocks, or high-risk gambling. We are talking about the most proven wealth creation machine in human history. The power of the 500 biggest companies in the United States. Moving forward, to truly master this strategy, you first need to understand exactly what you are buying. Think of the SP 500 as a giant elite club. Inside this club, you don't have just one or two risky stocks. You have the 500 most powerful and profitable companies in the U.S. economy. When you buy a single share of an SP 500 index fund, you are instantly becoming a partial owner of Apple, Microsoft, Amazon, Nvidia, and Visa. You own the software people use, the phones they carry, and the credit cards they swipe. But here is the real secret that most people miss. The SP 500 is self-cleansing. Every year, companies that stop growing or start failing are kicked out of the index. They are immediately replaced by the next rising stars. For example, decades ago, companies like Kodak or Sears were dominant. Today, they are gone, and companies like Tesla or Meta have taken their place. This means the index is designed to evolve and go up over time because it only keeps the winners. You never have to worry about one single company going bankrupt and ruining your life savings. Now, let's dive into the core engine of this wealth builder. The magic of compound interest. Albert Einstein reportedly called it the eighth wonder of the world, stating, "He who understands it, earns it. He who doesn't, pays it." Historically, the SP 500 has returned an average of about 10% per year over the last 50 to 70 years. This might not sound like much at first. If you invest $100 today, you'll have $110 next year. But here is where the magic happens. In the second year, you aren't just earning 10% on your $100, you are earning 10% on your $110. Let's look at the numbers for a regular person. If you invest just $100 a month starting at age 20, by the time you retire at 65, you'd have over $1.2 million. Let that sink in. Your total out-of-pocket contribution was only about $54,000. The other $1.1 million? That is pure, unadulterated profit from the market working for you while you sleep, while you travel, and while you live your life. This is the definition of passive income. At this point, you might be wondering about the risks, specifically inflation. In 2026, we know that inflation is the silent killer of wealth. If your bank pays you 1% interest, but inflation is 4%, you are actually losing 3% of your purchasing power every single year. By not investing, you are guaranteeing that your money loses value. The SP 500 acts as a natural hedge against inflation. When prices go up, companies like Amazon or Coca-Cola simply raise their prices to maintain their profit margins. As an owner of those companies, your wealth grows alongside those prices. So, how do you actually start? The good news is that you don't need a fancy broker or a financial advisor charging you high commissions to start this journey. In fact, those high fees are wealth killers. You can start today with 5 minutes and a smartphone. You are looking for two specific ticker symbols, VOO or SPY. These are called ETFs, or exchange-traded funds. VOO, managed by Vanguard, is one of the favorites for long-term investors because of its incredibly low expense ratio. It currently sits at 0.03%. This means if you have $10,000 invested, Vanguard only takes $3 a year to manage it for you. Compare that to traditional mutual funds that might charge you 1 or 2%, which could cost you hundreds of thousands of dollars in lost gains over 40 years. But before you jump in, we must address why most people fail. The answer is simple. Psychology. The market does not go up in a straight line. There will be years where the market drops 10, 20, or even 30%. These are called corrections, or bear markets. Most people panic. They see the red numbers on their screen, they listen to the scary news headlines, and they sell everything at the bottom. That is the only way to actually lose money in the S&P 500. If you look at history, the S&P 500 has recovered from every single crash it has ever faced. The Great Depression, World War II, the dot-com bubble, the 2008 financial crisis, and the pandemic. It has a 100% recovery rate. The secret isn't timing the market and trying to guess when it will crash. The secret is time in the market. You have to be willing to ride the roller coaster to reach the destination. To wrap this up, let's establish your plan of action. First, set up an automatic transfer. Even if it's $50 a month, the habit is more important than the amount. Second, buy an S&P 500 index fund like VOO. Third, and most importantly, do nothing. Ignore the news, ignore the hot stock tips from your friends, and let the 500 best companies in the world do the work for you. Your future self is counting on the decisions you make today. You don't need to be a genius to be wealthy, you just need to be disciplined. If you found this breakdown helpful and want to learn more about building a bulletproof portfolio, make sure to hit that subscribe button and turn on notifications. We are here to help you win the money game. Thanks for watching, and I'll see you in the next video.